Most people believe markets move because of bad news. A weak economic report comes out, prices fall. A strong number appears, prices rise. That's the story we're used to hearing. But if you've spent enough time watching markets closely, you learn something uncomfortable. Markets don't actually react to what everyone can already see. They react to what hasn't been fully understood yet. By the time a headline reaches your screen, the market has usually processed it, priced it in, and moved on. The real moves tend to start earlier, quietly, in places most people aren't looking, in rules, mechanics, positioning, and liquidity. That's why markets can rise on bad news and fall on good news. It's not irrational, it's informational. Right now, many investors are focused on one surface-level question. Is silver going up or down? That question misses what actually matters. The more important question is what has changed underneath the market structure itself, how participation works, how risk is managed, and who is still able to stay in the trade when conditions tighten. Those changes don't announce themselves loudly. They often look technical, boring even. But over time, they can quietly reshape who benefits, who gets pushed out, and how prices behave during periods of stress. If you only watch price, you're reacting. If you understand structure, you start anticipating. And that difference is where long-term edge comes from. Over the past several weeks, the silver market has experienced a rapid change in both price behavior and trading conditions. Silver prices moved sharply higher over a short period of time, reaching levels not seen in recent years. This move occurred alongside heightened volatility across precious metals broadly, with gold also trading near record highs. These movements signal a change in market dynamics rather than a routine fluctuation. At the same time, margin requirements for silver futures were adjusted upward by the exchange's clearing system. Maintenance margins were increased in steps, requiring significantly more cash for traders to maintain exposure. These are standard risk management procedures applied during periods of higher volatility. In parallel, delivery activity in the futures market increased. Data from January showed a higher than usual number of silver contracts standing for physical delivery relative to what is typically observed for a non-primary delivery month. Historically, delivery demand is concentrated in specific months such as March, May, July, September, and December. January is usually quieter by comparison, making these elevated figures notable in context. Vault reports showed ongoing movements of silver inventory, including withdrawals to meet delivery obligations. These changes follow several years of fluctuating global inventories as demand from industrial and investment uses evolved. Compared with conditions 1 month earlier, the key differences were speed and concentration, faster price moves, higher volatility, and tighter margin requirements. This marks a clear shift from prior stable conditions. At this stage, the observable facts are limited to these mechanical and numerical changes. The operating environment for silver traders has changed meaningfully over a matter of weeks. What matters most here is not any single data point, but how several mechanical changes interact with one another. The first-order effect of rising volatility is straightforward. When prices move faster and over wider ranges, clearinghouses increase margin requirements to reduce systemic risk. This is a standard process across futures markets. Higher margins mean participants must commit more capital to hold the same position, which immediately changes who can remain active. The second-order effect is more subtle. When margin requirements rise quickly, traders with limited capital are forced to reduce positions. This leads to position compression, fewer participants, lower leverage, and a concentration of exposure among larger players. In practical terms, access to the market narrows during periods of stress. At the same time, increased physical delivery activity alters incentives. Futures markets are designed primarily for price discovery and hedging, not for widespread physical settlement. When a larger number of contracts stand for delivery, especially outside of peak months, it shifts attention to mechanics and logistics. This does not imply failure, but it does change the focus of market participants. These two dynamics reinforce each other. Higher margins reduce speculative participation, while higher delivery demand draws attention to available supply. Together, they encourage more conservative positioning and shorter time horizons, particularly for leveraged traders. The impact is not evenly distributed. Short-term traders and smaller participants tend to feel these effects first. Their strategies rely on leverage. Commercial hedgers and larger institutions are typically better positioned to absorb increases. This asymmetry is not unique to silver. It is characteristic of most futures markets during periods of transition. Beyond the futures market, these changes can influence sentiment. Physical premiums and regional pricing often respond to shifts. These signals are watched closely by refiners, manufacturers, and long-term investors, even if they don't trade futures directly. The broader implication is not about imminent outcomes, but about sensitivity. Price movements can become less linear. Price movements become more reactive to incremental changes. Small developments can have outsized short-term effects. Understanding this helps explain why periods like this feel unstable without being disorderly. The market is responding to evolving constraints. Recognizing those constraints provides context that simple price charts cannot. Understanding the chain of cause and effect is key. Periods when market mechanics move into focus are not new. Throughout financial history, moments of heightened volatility have often been preceded not by dramatic headlines, but by quieter shifts in structure, changes in leverage, liquidity, or settlement behavior. One frequently referenced episode in the silver market is the late 1970s and early 1980s. During that period, silver prices rose rapidly alongside inflation concerns, currency instability, and speculative demand. In the months before the peak, volatility increased, margin requirements were adjusted, and participation narrowed. Leverage had increased, market access tightened, and regulatory responses accelerated once volatility crossed thresholds. However, using that episode as a direct template for today would be misleading. The structure of the silver market today is fundamentally different. Futures markets are more centralized, clearing systems are more robust, and transparency around inventory is far greater. Regulatory oversight is also broader, with clearer frameworks for managing risk across interconnected markets. There are also differences on the demand side. Today, silver demand is more diversified, with significant industrial usage. Industrial usage is tied to electronics, energy infrastructure, and manufacturing. This changes the context of supply and demand. Another distinction lies in information flow. Market participants now have near-instant access to positioning data and reports. This reduces information asymmetry, but it can also amplify short-term reactions as traders respond quickly. What history does offer is a framework for understanding behavior. When leverage becomes expensive, participation tends to decline. When multiple constraints tighten at once, markets often transition from momentum to range-bound consolidation. The key lesson is that markets under structural stress tend to reward discipline over conviction. Mistakes were caused by assuming familiarity persists. Historical context helps separate signal from emotion. Structural shifts deserve attention, but they simply redefine the rules. At this stage, the most useful way to think about the silver market is not in terms of predictions, but in terms of scenarios. Each scenario depends on how current conditions evolve, not on a single outcome that must occur. Bull case: structural tightness persists. If volatility remains elevated but stabilizes rather than collapses, and if delivery demand continues to absorb available inventories at a steady pace, and if margin requirements stop rising aggressively once risk metrics normalize, then silver could continue to exhibit underlying strength. In this scenario, higher capital requirements reduce excessive leverage without fully suppressing participation. Prices would not necessarily move in a straight line, but the market could establish higher ranges as supply constraints remain visible. Industrial demand, particularly from energy and technology sectors, would continue to provide baseline support. This outcome does not require extreme assumptions. It depends primarily on continuity, no sudden liquidity shock. Under these conditions, silver would behave less like a speculative instrument and more like a constrained commodity market adjusting to tighter conditions. Base case: adjustment and consolidation. The base case assumes that current stresses ease but do not disappear. If volatility moderates, and if delivery activity returns closer to historical norms, and if market participants adjust to higher margins by reducing leverage rather than exiting entirely, then silver may enter a period of consolidation. Participation would remain lower than during peak speculative phases, but healthier in composition. Liquidity would gradually improve. The focus shifts away from headlines and back toward fundamentals, supply growth, industrial demand, and monetary conditions. Price action may appear indecisive, but structurally, the market would be resetting rather than weakening. Bear case, liquidity shock, or demand reversal. This centers on what would need to change decisively to undermine current conditions. If broader financial markets experience a sharp risk-off event, or if forced deleveraging accelerates due to further margin increases, or if industrial demand weakens materially due to economic slowdown, then silver could retrace a meaningful portion of its recent gains. In this environment, liquidity becomes the dominant driver. Traders sell because capital preservation becomes the priority. Physical fundamentals may remain intact, but futures prices can still move sharply lower in the short term as positions are unwound. Across all three scenarios, the key takeaway is conditionality. No outcome is inevitable. The market is responding to evolving constraints. Different paths remain possible depending on how those constraints interact with macroeconomic conditions. When markets transition from calm to constrained conditions, headlines become less useful. What matters more are the indicators that reflect liquidity, positioning, and pressure points. These are the areas I'm watching most closely. First is the US dollar index, DXY. Silver, like most globally traded commodities, is sensitive to dollar strength. A sustained move higher in the dollar tends to tighten financial conditions and weigh on commodities priced in dollars. Conversely, a stabilizing or weakening dollar can relieve pressure, even if volatility remains elevated elsewhere. The direction matters less than the persistence of the move. Second are U.S. Treasury yields, particularly at the front and middle of the curve. Rising real yields increase the opportunity cost of holding non-yielding assets, while falling or stabilizing yields often coincide with renewed interest in metals. Sudden yield spikes can also trigger margin stress across asset classes, which can spill into commodities regardless of fundamentals. Third, I'm watching inflation data, especially CPI and PCE, not for the headline numbers but for surprises relative to expectations. Markets react to deviations from consensus more than absolute levels. Inflation that cools slower than expected can keep real rates constrained. Inflation that falls faster can shift policy expectations quickly. Both scenarios affect capital flows. Fourth is volume and liquidity in silver futures. Healthy markets show rising volume alongside orderly price movement. When volume dries up or spikes unevenly, it often signals forced activity rather than conviction. This is particularly important following margin adjustments. Fifth, I monitor open interest and positioning. Changes in open interest help distinguish between price moves driven by new participation versus liquidation. Falling open interest during price declines often reflects deleveraging rather than a change in long-term outlook. Finally, I pay attention to physical market signals, such as inventory classifications and delivery patterns, not as alarm bells, but as context. These indicators help explain why futures behavior may diverge from expectations based solely on price charts. Together, these inputs form a framework. None provide answers on their own, but taken collectively, they help separate noise from structure, and structure is where durable signals tend to emerge. Periods like this tend to feel more dramatic than they actually are. When volatility rises and market mechanics change quickly, it's easy to assume something is breaking. In reality, what we're often seeing is a system adjusting, sometimes abruptly, to new information, new risks, and new constraints. The silver market today is operating under tighter conditions than it was a few weeks ago. Participation has become more selective, capital requirements are higher, delivery dynamics are drawing more attention. None of that guarantees higher prices, lower prices, or any specific outcome. What it does require is discipline. Risk management matters more than conviction. Position sizing matters more than narratives. Patience matters more than timing. This isn't investment advice. It's simply how I'm reading the market right now. By focusing on structure, incentives, and probabilities rather than emotion or certainty, markets rarely reward those who react the fastest. They tend to reward those who stay measured when conditions change. If you understand what you own, why you own it, and what would change your view, you're already ahead of most participants. That's where long-term advantage comes from.